What's up guys and welcome to Wall Street Millennial. Over the past few weeks, GameStop stock has soared more than 1,500% and now has a market cap of over $22 billion. And it wasn't just GameStop. Other highly shorted stocks, including movie theater chain AMC and the maker of LaCroix sparkling water, also saw their shares skyrocket as retail investors started buying shares and short sellers panicked to cover. Besides producing unprecedented gain for Wall Street Bets users, the GameStop saga has led to potentially permanent changes in how the market functions. But before we get into what these changes are and how they happened, I'd like to announce that due to the actions of many retail brokerages, this channel will no longer be affiliated with Webull or any other stock trading apps that have affiliate marketing programs. Short sellers collectively lost more than $19 billion on GameStop alone, and they will be forced to reevaluate their short-selling businesses in the light of these losses. Before the short squeeze, there were roughly 2 million members on the Wall Street Bets forum. This has increased more than threefold to 7.5 million. Wall Street Bets is here to stay, and with such a huge number of users, its power is stronger than ever. For many years, hedge funds have made billions of dollars through so-called activist short selling, with the most prominent activist short sellers including Carson Block of Muddy Waters, Andrew Left of Citron Capital, and Jim Chanos of Kynekos Associates. The strategy is to short a stock and then to go on an interview with CNBC or Bloomberg talking about why the stock is bad. Because these short sellers have a strong reputation on Wall Street, this causes other investors to start selling the stock, pushing the stock price down, which benefits the short position. Another practice of the short sellers is to publish short reports online which explain why they think the stock is overvalued. This strategy has been profitable over the past decade. Reuters analyzed hundreds of activist short campaigns and found that on average, a stock decreases almost 4% on the day of the report and almost 8% over the course of the next year. The success of these short campaigns have caused many hedge funds to adopt this strategy, and the number of short campaigns has exploded to more than 700 in 2015, or about 2 reports released every day. Short sellers take most of the profits from the fall in share price as they make their short positions before the short report is released. They often buy puts with expiry dates right after the report is released, which maximizes their potential for profit. To be sure, there is nothing wrong in principle with publishing negative research on a company. For example, in 2019, an undisclosed hedge fund hired short-selling researcher Harry Markopolos to write a short report on General Electric. He wrote a 175-page report accusing the company of accounting fraud and calling them a, quote, bigger fraud than Enron, unquote. Here he is touting the short case on CNBC.
True that, there's still a conflict of interest here. How do you counter that?
I needed to get my team engaged, and I put a team of experts on this. And the public deserves to know. The shareholders deserve to know. I've been a big advocate for investor protection. I've done many cases on behalf of investors, including the foreign currency cases. I did the cases against many Ponzi schemes, including Bernie Madoff and several other billion-dollar-plus hedge funds that have been Ponzi's. I put a lot of people in prison over the years, and I'm just continuing that trend. And I need to get paid. I have a family to support.
Over the next few trading days, GE shares fell roughly 12%. So it's possible the hedge fund that hired him quickly covered their short and made a quick 12%, or possibly even bought puts and profited even more so. But the allegations of fraud turned out to be false, and the GE shares actually rebounded strongly after the initial dip, as CEO Larry Culp was revitalizing the business. In early 2020, GE stock did tank, but that was the result of the pandemic and nothing to do with Harry Markopolos' accusations of fraud. This example shows how activist short campaigns can be abused to manipulate a stock downwards for a short period of time, so hedge funds can make a quick profit. This comes at the expense of shareholders whose holdings unfairly decrease in value as a result of the manipulation. After the recent short squeeze in GameStop and the resulting existential losses suffered by Melvin, many investment professionals believe that hedge funds will no longer be as willing to short stocks as they once were. Kevin O'Leary recently said on a debate with the Secretary of the State of Massachusetts that he believes the force of retail investors will force hedge funds to think more carefully about shorting stocks.
If you are short, let it be transparent. You now run a new risk that these effective social media vigilantes are going to come after you and squeeze you as a short. That's going to make a lot of hedge funds think a second time before they try and go short stocks, which I think is great.
Traditionally, short sellers of a stock would borrow stock from a prime broker, put up collateral in the form of cash, pay an interest rate on the value of the borrowed stock, and hope to buy back the stock at a later date and at a lower price in order to return that borrowed stock and close out the position. However, if the stock price in fact goes up instead of down while they are short the stock, the prime brokers will raise the margin requirements so as to make sure the short seller will be able to cover their losses. Additionally, the interest rate may increase if there is a shortage of stock to lend out in order to encourage people to lend out the stock and discourage new short sellers from coming in. When the short sellers are too greedy in one stock and the amount of short sellers trying to cover their shorts becomes too great, the scarcity of stock will force them to bid higher and higher for the limited supply of stock. This in turn raises the stock price, and the positive feedback loop continues until enough people who are long the stock decide to sell their stock to the short sellers. In the case of GameStop, the situation became so severe that retail brokers, such as Robinhood, probably feared that the short sellers would not be able to pay back their losses. Because of this, they forced the supply of stock higher by banning any further buying of the stock on their platform. This obviously led to a drop in stock price as the buyers in the market were artificially wiped out, creating an opportunity for the shorts to cover their bets and thus preventing huge losses at the expense of those who were long the stock. This is just one possible explanation for what happened. Let me know what you guys think really happened behind the scenes in the comment section below. Whatever the case may be, the retail investors have won this time. According to Bloomberg, some of the world's biggest and most prestigious hedge funds, including D1 Capital, Point72, and Maple Lane, are down double digits due to the short squeezes. But Melvin Capital, the biggest loser, lost more than half of their AUM in 1 month as the fallout of the short squeeze. In an Investopedia article last year, it was reported that hedge funds were already seeing outflows of investor capital at a scale not seen since the 2008 financial crisis. This shift in the marketplace has culminated in Citron Capital's Andrew Left abandoning activist short selling, which he has practiced for more than a decade. He used to publish reports on stocks he is both long and short on his website, citronresearch.com, and is a frequent guest on CNBC and Bloomberg. He famously shorted GameStop at $40 right before it started to squeeze higher. He claims to have covered his short at around $90 for a loss of 100%. In response to this loss, he says he will no longer be publishing public short reports as this strategy obviously isn't working anymore.
Hi everyone, it's Andrew Left at Citron Research. 20 years ago, I started Citron with the intention of protecting the individual against Wall Street, against the frauds and the stock promotions that were just all over. When I started it, everyone used to say, can you just write whatever you want to write online and not be a registered brokerage firm and not be Merrill Lynch at the time? I said, sure, it's freedom of speech in this country, and if I'm telling the truth, I'm just going to write it. And for the first 15 years of existence, not CNBC or the Wall Street Journal even wanted to note the fact that we existed. Even the fact while we uncovered more fraud than any non-governmental agency out there. We helped bring down the drug pricing in this country against the better interest of the hedge funds. And we're proud of the work that we've done. But now, after 20 years, we noticed something. Where we started Citron was to be against the establishment. We've actually become the establishment. And we've done this whole thing without ever hiding from lawsuits, without ever hiding behind a pseudonym. But it's completely now lost its focus. So as of today, Citron Research will no longer be publishing what can be considered as short-selling reports.
He says Citron is now considered part of the establishment, being lumped in with other hedge funds like Melvin Capital, who also lost billions of dollars shorting GameStop. He says that as a result, he will no longer be publishing short reports, although he does not rule out continuing to short stocks privately.
The Citron narrative is going to change and have a pivot. What gets lost in the whole Citron Research world is the fact that last year the performance of the Citron Fund and Citron Research on our long recommendations was up 121% average from recommendation to high point of stocks. And that was in 2020. We want to bring investors stocks that they can make 5, 10 times their money on, but at the same time have strong management teams, ethical business practices, business models that are forward-thinking, socially conscious. And we're going to bring that to the individuals. These companies can use the support of a whole new generation of shareholders that have an appetite to buy stocks. If you choose to buy GameStop here, it's caveat emptor. You know what we think about their business model. It's on you. Too much has already been written. But until then, we'll have our first story ready on Monday. We want everyone to breathe, smile. We're excited for the next 10, 20 years of Citron. Hopefully, we can put our experience to add some sanity and most of all, some kindness back in this market. Cautious investing to all, and have a great weekend.
He points out that while shorting has been a disaster recently, his firm actually made some pretty good long recommendations. In October of 2020, he recommended buying Nigerian e-commerce company Jumia Technologies, and shares are up almost 300% since then. It will be interesting to see how his long recommendations do in 2021. Alright guys, that wraps it up for this video. Make sure to check out our second channel, WSM Research, where we just published videos about the top trending stocks on the market. Also follow us on TikTok, link in the description below. As always, thank you guys so much for watching. Wall Street Millennial, signing out.